Morning friends, welcome to Ecoholics YouTube channel. Friends, in this video I am going to discuss with you important current affairs for 3rd May 2024. If I am audible and visible to you, please comment. If there is any issue, please comment. So let us start with our discussion. So as you know that this is the third video in the series that we have started for you, where we will be discussing important current affairs related to economics from important newspapers. So right now I am following Mint, and we have already discussed quite a few topics so far. And in today's lecture, my objective is to discuss four very new, very different topics with you, right? These are very much related to the syllabus that you will encounter in the examination. For instance, we'll be talking about the Purchasing Managers Index related to the manufacturing sector in India. We will be talking about aging population and what the Asian Development Bank says about it in its latest report. We will also be speaking about recent developments in the bond market and what are the kind of steps that we are taking to, let us say, deepen the bond market in India to further attract retail investors into the bond market in India. And we'll be wrapping finally up by talking about spices exports from India and what are the hurdles, what are the challenges that we are facing in the export of spices from India, which is an important agricultural export. So as you can see that these are very important topics, very different topics from what we have already covered so far. The idea being that in this half an hour, 35 to 40 minutes discussion, I want to expand your horizons. I want you to be able to appreciate a lot of things that are happening. You can always download this content from our website. You can get this content from our groups, etc. I would encourage you to definitely download the Ecoholics app, because there's a lot of current affairs related content such as weekly magazines and monthly magazines that are available. So as you can see that we are working across the spectrum of economics, right? So that your understanding is there, so that you're prepared for the examination. Now let us directly jump into our discussion today. If there is any doubt that you all have from our previous discussions, then please feel free to ask. Absolutely anything that you would like to, share with me, ask me, or discuss with me, please feel free to use the comment section. If you need any special topic to be covered, let us say in these lectures, you can always make that kind of a request, right? I'm open, right? So thank you for joining in, Rashmi as well as Charulata. Good morning and thank you for joining in. Rashmi, I really appreciate your consistency. I would encourage other students to also be very consistent in these lectures. I will also be very consistent from my side, right? So manufacturing activity is an important activity, right? It creates jobs, it helps in GDP growth, it helps in earning and export revenue. So manufacturing is an important activity that we are tracking, right? And we track this activity on a monthly basis. So manufacturing activity is continuing with its stellar run. It is showing strong expansion, right? So we are gauging manufacturing in activity using an index. The name of that index is Manufacturing Purchasing Managers Index. So the typical idea behind creating a purchasing managers index is that if I am, let us say, a purchase manager in a particular firm, then I would have an idea of what the future order book is looking like, and based on that I will, let us say, purchase raw material today. So the underlying idea is that if my purchase of raw material today is strong, or if my sentiments are strong, that basically would reflect, let us say, what is expected or what is going to happen in the immediate future. Because let's say that if I'm a largish firm and I'm, let's say, forecasting my inventory for 2 months down the line or 3 months down the line, and I can see a strong order book, then that means that the sentiments are strong. That's the basic underlying idea. That if a purchasing manager such as me is, making good raw material purchases, strong raw material purchases, I'm taking strong inventory positions, that will reflect positively. That means that the economy going ahead, or the demand situation going ahead, should be positive. That's the basic underlying idea. Having said that, the HSBC India Purchasing Managers Index is compiled by S&P Global. It is standing at a value of 58.8. The index value is 58.8. It is just a little lower than the 16-year high of 15.1 that we had hit in April 2024. We are way above the neutral mark of 50.0. So any index value above 50 indicates an expansion in activity. Any index value less than 50 indicates a contraction in the economic activity associated with manufacturing. So like for instance, when we were in the throes of COVID-19 pandemic. So at that point of time, the value must have shrunken below 50, right? Now we are way above 50, so that's a very positive sign. And the long run average for purchasing managers index is 53.9. So you can see that we are way above the long term average as well. That is precisely what has been reiterated over here, that 50 above expansion, 50 below contraction. One of the problems that we may encounter going ahead is that of cost pressures, right? That the raw material costs, labor costs are a little bit on the higher side, as a result of which the output prices are a little bit on the higher side, right? But now, so far as our firms are concerned, the good thing is that the demand is pretty strong, right? So when demand is strong, so I as a manufacturer, I can pass on the price burden onto the consumer. I don't need to absorb it. To put this into the right context, for a long period of time during and after the COVID-19 pandemic, producers were absorbing a lot of cost pressures, right? They were not passing on the increased raw material prices to, let us say, their consumers. Why? Because they were afraid that if we pass on the increased raw material prices to our consumers, so our consumers will be scared away. The demand that we are facing, that demand that may decline. So we will suffer furthermore. So they were absorbing a lot of costs, right? They were not passing it on to their consumers. But now what is happening is that, given the fact that the demand is resilient, right? Hence, a lot of these increased raw material costs, etc., are reflecting in higher prices that producers are charging. So producers are also making a decent enough margin, right? Now this is back-to-back good news that is coming for the Indian economy, right? Like for instance, we had recorded an 8.4% growth in the December quarter. I mean, the October, November, December period, we registered an 8.4% growth. And that growth was supported by decent government spending. You know that there are four engines of demand in any economy. So that is consumption expenditure, investment expenditure, government expenditure, and let us say net export expenditure. So on the back of strong government expenditure, we were able to have a decent amount of growth in the October, November, December period. And now manufacturing activity is doing good for itself. So that's all in all positive for the Indian economy, which needs to create more jobs, which needs to create more opportunity, right? So stock purchases are good, conditions are conducive, right? And domestic market demand is strong, employment market is looking up, because when these guys are forecasting better activity and increased production going ahead, then of course employment market also starts looking up, right? So there has been some hiring which has started in a lot of these companies. Vendor performances have improved, and forecast is that of a higher output. So this is basically my submission regarding purchasing managers index. If there's absolutely any doubt, or if there's absolutely that you'd like to ask, say, or share, if let's say that you have read something, right, and you feel that you have a comment that can add value to our discussion, please feel free to use the chat box, right? Until then, I'll move ahead to the next topic. So the next topic that I'm going to talk about is demographic dividend. So there is this annual general meeting that is happening of Asian Development Bank, and they have come out with a report talking about demographic dividend, not only from, let us say, an India point of view, but from, let us say, an Asia point of view, right? And there is a new term that I have come across that I would like to discuss with you, is that of silver dividend, right? So this is a very interesting discussion, right? So you know that there are four factors of production, that is land, labor, capital, and entrepreneurship, right? So labor is obviously an important factor of production, and any economy that is blessed with a strong supply of young labor which can participate in the workforce, so that economy can afford to, or can be able to increase its production, right? It can increase production at a faster rate. It can enjoy high economic growth that will translate into good national income, good per capita income. Growth rate in per capita income will also be good, because ultimately it is all linked with production, and production is dependent upon factors of production, and factor of production is labor. And if you're having labor in abundance, and I'm talking about good quality labor in the sense that educated labor force, skilled labor force, trained labor force, employable labor force which has opportunities. So you see that I have attached a lot of caveats, right? So if you have these things happening in your economy, that if you have a sizable chunk of well-trained, educated labor force which is able to grab opportunities, which is able to find jobs, etc., right? So that is like super helpful for the growth of your economy. That is super helpful for the growth in your national incomes and per capita income, right? But eventually this labor which is young today will become old tomorrow, right? And that is what this particular article is talking about, the challenge of aging population, right? Eventually people will start getting older. Like for instance, if I am in my 30s today, let us say by 2050s I'll be in my 60s, right? Which is natural, right? So that is going to be a challenge, and obviously your demographic dividend will eventually reduce, it will eventually come down. And that is what the Asian Development Bank is discussing, that what are the policy ramifications, what are the budgeting ramifications associated with this. And here they are talking about a silver dividend. What do you mean by silver dividend? So let's say that you have old population, guys who are, let us say, above 50, and definitely guys who are above 60, right? So it's not that if somebody is above 60 they cannot do any work, right? Because life expectancy has increased, quality of life has increased, healthcare services are better. So it's not as that person above 60 cannot work at all. So that's what they are saying, that if you are having the right ecosystem, right? Like for instance, if we have the health services available, if we have education, reskilling and retraining services available for even those who are above 60, then even they can continue to contribute in the production process in the country, right? That is what the idea of silver dividend is. So the report that I'm talking about is Aging Well in Asia, Asian Development Policy Report 2024. This report, like I said, has been released during the 57th annual meeting, right? And they're talking about the old age dependency ratio. Now, what is the old age dependency ratio? It's a fairly straightforward concept to understand. Old age dependency ratio essentially is talking about putting the number of people above 60 in the numerator, putting, let us say, people in the range of 15 to 59 in the denominator, and multiply this by 100, and you will get a percentage, or you will get some kind of an idea as to what is the old age dependency ratio, right? So this old age dependency ratio right now, it is 20%, right, in 2022, right? And it is likely to increase to over 30% by 2050, right? So definitely people who are young today and can work today may not be able to do so going ahead. So your demographic dividend will definitely dwindle, right? And it will reduce India's per capita GDP growth by 0.053 percentage points, right? So eventually it will have an impact. The dwindling of demographic dividend, which is basically indicating the young population that can work. So the reduction in those numbers will definitely have an impact on the growth per capita, right? And again, reiterating some obvious logic, that if you have a young population, that is a demographic tailwind that kind of, acts like a booster to your economy. It pushes your economy ahead, right? On the other hand, having a significant number of old people in your economy, that is like a tailwind, right? That is like something which is coming from front and it slows you down. That's precisely how it's supposed to be. And that's something that we can tackle. How can we tackle that? That if you ensure that the old people, their well-being is ensured, their healthcare is ensured, they are educated, then you can tap into their working capacity and you can productively employ them as well. And this is not something which is unheard of. Like for instance, if you look around your families and if you look at the society in general, there are a lot of people who are above 60, right, who want to work, who don't want to sit at home, but they don't find appropriate avenues for a variety of reasons. Maybe because the retirement age is such, or maybe because the societal norms are such. But these people are active, these people have energy, and that can be tapped into. And if you're able to tap into the silver dividend, then you will be able to improve your GDP growth rate by 1.5 percentage points. That is the estimation that is coming out, right? So that's what the idea is. Now, what are the fiscal policy ramifications? Well, the fiscal policy ramifications are that governments will have to decide, right, that how is it that they are going to park their resources today so that they are in a position to take care of these challenges as they are evolving, right? So the governments, they will have to start putting in place programs related to health insurance, pension, and long-term care needs, because these programs will eventually help you. Speaking from an Indian point of view, Like for instance, I'm aware of this Pradhan Mantri Vaya Vandana Yojana, right? For instance, I'm aware of a variety of pension schemes which have been started recently by the government, uh, catering to the requirements of, let us say, traders, catering to the requirement of, let us say, the informal workers. There is a plethora of health insurance schemes that are running, right? And a lot of them are also linked with your Jandhan accounts, right? So you have a variety of health insurance schemes, not just for the formal sector folks, but also for the informal sector folks. You also have something called as Jan Arogya Yojana, Pradhan Mantri Jan Arogya Yojana, which is offering you 5 lakh rupees worth of insurance as a family, right, for your hospitalization needs, right? So a variety of steps have been taken. But if you look at India's expenditure on healthcare as a percentage of GDP, then we're still lagging behind as compared to our Southeast Asian peers, as compared to, let us say, BRICS countries. So that is where we need to kind of ramp up our, efforts, and we need to do a disaggregated analysis as well, because right now a lot of our resources are going towards healthcare and wellness for children and for teenagers, rightly so. But then going ahead slowly and steadily, we need to divert resources towards the older population more and more as their numbers increase in the population. So towards that extent, fiscal deficit is always going to be on our minds. So therefore, we have to work on tax resource mobilization. Therefore, we have to work on attracting public and private investments, especially into preventive and curative healthcare and lifelong education, if we really want to reap the silver dividend. So this is the takeaway out of this article. I hope that this made sense, right? Now I'll move ahead and I'll talk about the next important article. So you can see that we are discussing a variety of different content over here. So if you're liking the video, do please like, share and subscribe to our channel, and definitely access all of these contents through our apps and through our groups, etc. Right? Now I would like to speak about the bond market. Okay, this is a very important topic in insofar as being able to finance our growth, right? So let's say that you are a company, you are looking out for 1000 crores. What options do you have apart from borrowing it from banks? Can you borrow it easily from the bond market? Can you borrow it cheaply from the bond market? Okay, what do I mean by a bond, right? So see, typically if you want to raise funds, there are two basic ways of doing that, right? You can either go via the equity route or you can go via the bond route. Equity route meaning that you can probably, create new shares and sell those shares, right? That means that your ownership will get diluted. You're onboarding new owners into your company, and those new owners are basically purchasing your shares and giving you money in return, right? So that's one way of raising capital, right? Another typical way of raising capital is taking a loan from banks, right? That banks have collected a lot of money from depositors. Banks are looking out for productive, credit opportunities where they can give loan, right? You know how banks make money, right? That banks collect depositors, banks collect deposits from depositors, and they pay a rate of interest to depositors. And then this money that they have pooled, they will loan it out. They will give a credit to someone and charge a higher rate of interest, right? So there is a differential, so that banks earn a higher rate of interest, they pay a lower rate of interest, and the delta is what helps the bank remain a profitable venture, right? So you can go to a bank and take a loan. You can print new shares or create new shares and sell it to new shareholders or whatever, right? And then there is another approach of bonds. Bonds are basically debt instruments. So if you are, let us say, somebody who is looking out for money, you could be a government of India, you could be a government of Maharashtra, you could be a private corporate, you could be a municipal body, you could be any of these organizations, agencies or institutions, right? And you may need money, and to get the money you may basically issue a bond, which is essentially a debt instrument which says that, okay, I'm borrowing X amount of money from you for, let us say, 10 years. Every year I'll pay you this much amount of interest, and at the end of the 10th year, let's say that you will get your entire principal amount back. You will get the entire amount that you invested upfront, you will get it back after the 10th year. That's basically what a bond is, right? Right now, selling bonds in India to retail investors. What do I mean by retail investors? Small time investors like probably you and me, right? Who want to invest, but we are not extremely wealthy characters, right? So we want to invest, but we want to invest smaller sums of money, right? In a very fair and a very transparent and a very trustworthy manner, in a manner such that we don't get stuck in that investment, right? In a manner that that investment sort of helps me as an investor in achieving my investment goals, right? So of course, you know that there is a huge middle class in India, right? And if we could take these instruments not just to, let us say, middle class, but to the entire population, whoever wants to invest, and if we could get them to invest in these bonds, that would be like amazing for companies who are looking to raise capital in a cheap and an efficient manner, right? So you don't necessarily need to go to banks alone, right? You don't necessarily need to go to the equity market. So this creates an avenue, that this creates an option for you, and having options is always good. Now let us see what is happening in this particular space right now. There is this concept of sachetization, right? You must have definitely gone to a Kirana store and you must have definitely seen jazzy, different colored, sachets of shampoos, hanging from the rack or whatever in the Kirana store. So you may have seen a pink sachet, a black sachet, a white sachet, a yellow sachet, a white and blue sachet, a silver sachet, a gold sachet, right? So sachets are basically small packs of shampoos, right? So sachetization of shampoo was quite revolutionary so far as the shampoo segment in India is concerned, right? Like for instance, when only 100 rupees bottles were available, so those who were at the bottom of the pyramid, right, or those who couldn't really, or those who did not have the willingness to pay 100 rupees, they kind of stayed out of the market. They did not make the purchase. But the moment you converted that 100 rupees bottle into a sachet which was costing only 1 rupees or 2 rupees, then that 1 rupee or 2 rupee shampoo became accessible, affordable for everyone, literally everyone, and the willingness to pay was definitely there. 1 rupees, 2 rupees was definitely something that people were willing to pay, right? And therefore your entire shampoo market started hitting stratospheric highs, right? It absolutely exploded, right? Now can we replicate this kind of sachetization in the bond markets, in the financial markets? And the answer is yes. Why is the answer yes? So earlier the minimum investment that you could do in bonds was, let us say, around 1 lakh rupees, right? So most of the bonds are privately placed listed bonds, in the sense that somebody comes to my house and sells me a bond. That is what I mean by privately placed, right? Listed bonds in the sense that those bonds are listed and I can probably get out of those bonds through a secondary market, right? So there is a market that exists where I can go and sell these bonds. That's basically how a listed bond will work, right? So essentially, if you keep a threshold of 1 lakh rupees, right, a lot of people, let us say, who are earning a salary of 20,000 rupees, 25,000 rupees, 30,000 rupees per month, a lot of such folks like me will probably be excluded, right? On the other hand, if you are reducing the minimum ticket size to, let us say, only rupees 10,000, right, then a lot of folks will be interested in entering into the bond market. And this is for real, guys. This is for real, right? That if you reduce the threshold amount, right, then there will be a lot of people who will suddenly start looking at this. There are a lot of arguments that I'll be presenting to you why this is the case. Like for instance, Mr. Uday Kotak, right? So he mentioned that India's growth story will be a one-legged race if our debt market is not strong enough. That means that if you're relying only on the equity market for our capital requirements, that basically means that we are not going to be so strong, right? So the financial market is almost like your heart, right? What does the financial market do? Financial market gathers savings in a variety of forms from the nook and corner of the country and then pumps those savings into productive investments. So financial market should have a number of different levers. So equity market is one of the levers. Banks is one of the levers. Why not have another lever in the form of bond market? Then your heart is stronger. Your financial market is stronger, more efficient. That's what the whole idea is. So retail participation is imperative, right? I mean, today, if you look at the way Nifty and the way the Sensex is behaving and the way the mutual fund industry in India is growing, right? So a lot of retail investors are there in the stock market. They are pumping their hard-earned money in the stock market. They believe in the India growth story. And this number is only going to increase going ahead. It's not going to decrease, right? So can we similarly have retail participation also happen in the bonds market. That's what the whole idea is, right? 98% of the bond market is this privately placed listed bonds where the threshold is 1 lakh rupees, right? This is a very high entry barrier. It's a deterrent for a majority of retail investors. What happens is that I want to invest, but if I'm forced to invest entire 1 lakh rupees in a bond of one company, that may be too risky for me. I may not be signing up for the same. Whereas if I can break, let us say, the 1 lakh rupees that I want to invest, not in one company, but probably in 5 companies, bonds of 5 different companies. I like that. I like that approach. Why do I like that approach? Because if one company goes bust and I lose my entire investment, then that is a very big problem. But if I have divided my investment into 5 companies, then the chances that all 5 companies will go bust is very bad, very unlikely. I can target a variety of those companies. Like for instance, if I invest 1 lakh rupees in one company, that's just one company. But if I'm investing in 5 companies, what I can do is that I can invest in 4 decent companies which are offering only okay rate of interest, right? But in probably one company, I can take a little bit of a risk, try to earn a little bit of a higher this thing. So what I'm basically trying to tell you is that the moment you reduce the 1 lakh rupees barrier and make it 10,000, right? Then you basically give me a lot of options. You allow me to achieve my financial goals. You are basically democratizing my options. You are allowing me to design my portfolio the way I want to design it, right? Apart from that, having bonds in your portfolio, that will offer you multiple benefits. It will offer you stability, predictable returns, lower risks. You can get inflation beating returns. Some bonds are inflation linked, meaning that if inflation is X percentage, that bond will pay you X plus 2%. So whatever is the inflation, you will get always X plus 2%. So those kinds of bonds are also there, right? Right now, decent bonds, highly rated bonds in AA category, they are giving 10 to 11% fixed returns to investors. If you go and open an FD today, you will typically get around, let's say around 7-8% or 8-9%. But on AA category, and the best one is AAA category, please just keep that in mind. So something which is a little less than the best, it's a little risky. So, but it's not going to, it shouldn't really evaporate overnight, right? So those kinds of bonds are giving you 10 to 11% rate of interest, right? Bond issuers, right? They can tap a larger investor base. If this 1 lakh ka threshold is reduced to 10,000 ka threshold, you will not be overly dependent upon banks. RBI as it is doesn't want companies such as NBFCs to be overly dependent upon banks for funds. So it will be a silver lining for NBFCs as well if the bond market is developing in India, right? So issuers, they can diversify their investor pool. They can lower their cost of capital. Retail investors can enter into the market. The secondary bond market will also become stronger. So primary market is a market of new bond issues. So newly issued bonds are sold for the first time in the primary market. An already issued bond can be traded, and that kind of a trade is happening in the secondary market. So I've explained you the difference between primary market and secondary market, but if there is any doubt, you can please feel free to ask, right? There will be greater liquidity in the market because of these kinds of steps, right? Already the regulator has done a lot to gain the trust and create the legitimacy for our markets. Like for instance, we have an online bond platforms, right? So that online bond platform is again very transparent, user-friendly interface and so on and so forth, which engenders a lot of trust and confidence, right? There are stringent regulations on unlisted bonds. People often lose a lot of money in shady investments, right? Not always all unlisted bonds are shady investments, but you need to regulate these unlisted bonds, right? Because these unlisted bonds are essentially flying under the SEBI's radar for a very long period of time, right? So what can we do about them? We don't want people to lose their money, right? And then of course this phase reduction in minimum investment size, right? So coupled with rising investor education, right? If we are able to take a variety of different steps that encourages the entry of retail investors into the bond market, that would be super helpful for the investor who will get better options of investment, for the issuer who will be able to raise capital more easily, efficiently, and probably in a less expensive manner. It is helpful for the corporates who are looking out for funds so that they can grow, they can invest. So it will be helpful for them. It will be therefore helpful for the economy, because if your corporates, if your agencies, if your governments, they are able to raise funds and spend funds and create the ecosystem for growth and help in the GDP growth rate, create more jobs, should be helpful for everybody. So in that sense, these small steps when added together, they can make a huge impact. So that's the important takeaway out of this article. If there is any doubt that you are having, please reach out, right? Please ask, please discuss, right? If you are stuck in your career at some point of time, and if you feel that mentors from Ecoholics can be of help to you, you can always reach out to us. It's very much possible that you can talk to us. So just keep that in mind as well. Okay. Moving ahead, there are a lot of articles being published in a variety of publications talking about India's export of masalas or spices, right? So as you know that, we are famous for masalas, not just now, but for like thousands of years. We have been exporting a lot of masalas, a lot of spices, right? And now these spices are coming under scanner for all the wrong reasons, right? So there are a lot of contamination related issues. So a lot of these spices have been contaminated. They are having higher ethylene oxide than what they should have. Some of them are having a greater concentration of lead than what they should have. Some of them are having presence of salmonella, which is a very dangerous bacteria which can make you seriously sick. So that kind of bacteria has been found in some of these masalas, right? So it's not just United States of America or just one or two countries which are taking action against us, whether it is Hong Kong or it is Singapore or it is Malaysia or US or Australia or European countries such as, let us say, Netherlands, right? So there has been action which has been initiated against our food exports, right? And we need to do something about it. That is what this article is going to discuss, right? So what the Food Safety and Standards Authority of India has done is that they have ordered a nationwide testing and inspection at all companies that are making spices mixes, that is masalas basically. And this comes after Hong Kong and Singapore, they banned the ready-made spices from MDH and Everest. MDH and Everest are household names. Like for instance, just as I was talking about this or reading about this, yesterday my father asked me to order some Everest ka Tikha Lal from Amazon, right? So you can understand how much of a household name it is, right? So India is exporting masalas worth $4.2 billion, right? So $1 billion is, let's say, approximately 8,000 crores. So we are looking at an industry value of around 33,000 crores at least, right? So 33,000 crores worth of masalas were exported. That was a 12.3% growth YOY, right? As compared to the year before last, right? 12.3% growth is what we witnessed last year. We are sending our masalas to China, US, UAE, Thailand. They are our major buyers, right? And these spices, they command close to 10% share in India's agriculture export basket. So definitely we want to increase the size of our agricultural export basket, and masalas have a role to play, right? So we really need to get our act right. So this is what the exports growth story looks like. You can see that numbers are reaching all-time high, right? You can see the YOY growth is pretty good, right? These are our major markets, right? You can see China is right there at the top, right? Followed by US, Bangladesh, UAE, Thailand, Malaysia, Indonesia, UK, Sri Lanka, and Saudi Arabia, right? If you look at the kind of spices that are dominating, so again it is chili, the Tikha Lal probably that I was talking about. So your chili, cumin, etc. are getting exported in a very big way, right? But there are consistent quality concerns. Like I mentioned, pathogen related violations, salmonella, right? So 5,115 food products, they have been rejected. 23% of refusals that US has done for food products, 23% of those refusals are only for Indian products. This is a kind of reputation that we don't want, right? We need to get away from it, right? So these are the major players: Everest, right? And Mahashian and Sakti and Achi and Eastern Condiments. Okay. European Union has also been known to reject consignments from India due to a variety of risk factors. So potential risk, potentially serious. So typically any time when these kinds of rejections happen, our industry associations, regulator and ministries, they are quick to dismiss it as a propaganda against India. They are quick to dismiss it, saying that adequate details are not being shared, so we don't know what is happening. We really need to get our acts right? And there are a variety of stakeholders who need to get their act right? So whether it is a producer or whether it is the association or whether it is the FSSAI or whether it is the Quality Council of India, or whether it's the Ministry of Commerce, which is a parent agency for most of these organizations, we really need to get our act right. I remember that there was this scheme that was launched, zero effect, zero defect, with the idea being that India will be known for best quality products. Those ideas and those schemes actually need to get translated into reality, into as important an area as, let us say, foods, or let us say drugs or pharmaceutical products, because these are, they can threaten your well-being and they can leave a very bad taste in your mouth, right? So if you look at the spices board, it works under the commerce ministry. It is responsible for testing and certification, and it is severely short staffed. 1/3 of the staff strength is vacant, right? I don't know how they are going to then do quality certification. If you look at the number of testing laboratories in India, right, we just have like 9 quality evaluation labs, right? And you look at the scale of our exports, we're talking about 35,000 crores worth of export probably in this fiscal, and we have only 9 labs, right? So how is it that 9 labs will, so do you think that each lab can basically be held accountable for approximately 4,000 crore worth of exports, right? Doesn't look like, right? So we really need to do something about this as well, right? So there are a lot of quality concerns, there are a lot of issues that I have highlighted to you. So this was my entire submission to you guys today, right? I hope that you all had a great time learning. If there is absolutely any doubt, there's absolutely any question, there's absolutely anything that you'd like to discuss with us, any kind of career guidance that you want, any kind of exam guidance that you want related to, let us say, RBI, IES, IAS, or any of these examinations that we are so good at, right? So please reach out to us. Thank you so much. All the very best, and take care, guys. Thank you so much.